Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hey, welcome back, everybody, to the Ideal Investor Show. Today, I wanted to bring something to your attention. And for some of you, depending on where you're investing actually in residential real estate with our help or on your own, you may have already heard this, or it might also be that you heard it or be affected by it as the owner of a house. It's just basically your residence, because there have been many, many reports about the issue and the situation that I'm talking about today, and that is insurance for your home. And in Florida specifically, with the hurricanes and stuff like that, more and more insurance companies have either extremely increased their policy, their rates basically, or they just flat out refuse to write insurance policies because they claim that the risk is just too high. That was kind of like one of the triggers that I've heard about, like more and more people struggling to actually get insurance. And I wanted to make a little episode about it with two aspects. One of the more recent news I got, because it's now spreading outside of California. And then the other thing is to talk about what can we actually do. The first thing is you want to understand that the whole idea of an insurance policy is that a whole bunch of people regularly every month or every year pay into a policy so that the company that actually offers the policy has a huge pile of money. And then when a few people of all the people who have a policy have damages, then out of that pile of money, the damages can be paid. Basically, you file an insurance claim and you get the money if the claim is accepted. Now, everybody knows that insurance companies find all kinds of shenanigans to never have to pay, because they obviously can keep some of the money and they can work with the money as long as it is not needed to pay out claims. So some people say insurance companies that have like homeowners insurance and renters insurance and so forth are really more financial institutions with an insurance business attached to the side, because every time everybody who has a policy is making a payment, they get a pile of money that they can basically use. Now, they can't use it freely on the market and do very high risk investments, but still, if you look at the fact that bonds, for example, which are allowed for insurance companies, can get 5, 6, 7% interest right now. So they're making money with your money. And then they basically keep asking you to pay more and more money to have this policy, because more and more things have been happening, from wildfires to hurricanes and so forth. Now, if they were really using the money very well and wouldn't pay themselves and their agents all these fees and salaries, then that kind of a business should never really go bankrupt. To the current news that I found that triggered me to actually say, let's have an episode about it on the show. And that is an application by State Farm Insurance, which you probably all have seen commercials about, with like that slogan, State Farm is here. Well, maybe they're not so much here anymore, because they already been pulling out of Florida. And now they made an application to the insurance regulator of the state of California when it comes to people, like 42 million people living there. And they applied to have permission to increase their rates by 30% for homeowners insurance, so when you live in the home yourself, by 36% for condo owners insurance, so when you own a condo or an apartment, you live in that, and by 52% for renters insurance. So that means when we have tenants in our properties, in the property we're in California, and we ask them to have renters insurance, and they pay, let's say, $500 a year. So now, if this gets approved, they would pay $750 a year, right? Which would be a significant increase in rent for nothing. And the regulator, in a surprising move, said, we will do a full audit of State Farm's finances to find out if they have any leg to stand on to ask for these extreme increases. Now, you have to also know that State Farm is not allowing any new homeowners insurance policies or any kind of real estate related insurance policy in the state of California. And sometimes when you already have a State Farm policy, they make your life hard to renew it. Their argument is obviously too much bad weather and flooding and wildfires and all this kind of stuff. So I just want you to be aware of that. And I want to bring it up for you to check, Because in the vast, vast majority of cases, when people buy property, whether it's investment property or for your own residence, and you buy it with a mortgage, then most people are actually enrolling all these recurring costs into what's called the escrow, right? So your mortgage itself is basically principal and interest, just like you signed on the dotted line at closing. But what most people also include is the property taxes and the insurance. What happens is you have your monthly payment and it's expected to be the same, but sometimes it can jump, and it can jump for two reasons. The one reason is that your property taxes increase, which outside of California can happen very dramatically if the value of properties in the area increase, because there are certain states where properties in the last 4 years have gone up by 50%. So then the state treasurer comes along and says, well, if the property is 50% worth more, then we also need to collect 50% more property tax. And so if you paid $1,000 per month, like in California, and they increase it, now in California they can, but let's say you are in New York and they say properties increased in value by 50%, then your $12,000 a year can suddenly jump to $18,000 a year. Right. And if you think about that, that's like $500 more per month in your mortgage payment. And the other area where something similar, not typically quite as dramatic, but still also an unexpected increase, is your insurance. And when you ask yourself, hey, I got a 30-year mortgage and I was told that my payment is always the same. Well, really, it's only the same for principal and interest. Insurance and property tax can go up. So I really highly encourage you to look at your statement when it comes in, either electronically or in paper every month, and look at the escrow numbers and see how they actually develop so you don't get surprised. Now, the other question that comes up is, what do I do if I have a residence in a state where the insurance company doesn't either want to insure me at all anymore, they moved out, or they have jacked up the prices massively? What do I do? And one thing that you might want to consider is, we always as investors talk about creating a reserve. You might actually want to ask yourself if you can create a reserve that can cover you for the vast majority of situations. Now, if your house burns down or there's a hurricane and rips your house away, I don't see any way that you can save enough money in a reserve so that you can replace the whole house, right? So that would be an extreme catastrophic thing. But what you could potentially do is save money for all those kind of things, let's say up to $10,000, $20,000, $30,000, $40,000 expenses, so that ultimately you can get away from having to pay the insurance. Now, one thing that is a tricky issue is that oftentimes the mortgage companies require insurance. You would have to go and say, okay, here I tried to get insurance and the insurance doesn't want to take me, or the insurance is too expensive. In some cases, you might get away with it. In some cases, you might not. But one thing you can always do is increase the deductible to the maximum amount possible, because that's ultimately going to reduce your payment per month. And if you have like a $5,000 deductible, then yes, everything that is below $5,000 you have to pay out of pocket, for which you can use that reserve. But you're no longer paying higher and higher rates because the high deductibles are cheaper. So if you currently have $1,000 or $2,000 and your insurance is going up, I would recommend increase your deductible. So that's one way to actually keep the costs in check. Now, you can't do it forever because there is not much more than $5,000 you can do, but at least that's something, because most people have their deductible as between $1,000 and $2,500. And so you have a little bit of room to crank it up and lower your monthly rate. So I hope that was educational for you. I think it is not okay that there is no way, like we can get government-insured mortgages. I think there should also be something like a government-insured policy, because that would be the biggest policy, right? There are probably 100 million homes in the United States, and if everybody had the opportunity to get a general coverage for devastating complete losses, then the rates should be relatively small, because the losses never occur to a large number of people all at once. So that's my opinion on it. I wanted you to be informed about it, but most importantly, take a close look at your policies and take a close look at your mortgage statement in the area where it talks about escrow. So that's it for today. Be well and stay safe, and I'll talk to you tomorrow.